All right. I want to go ahead and go over this is tax deed tip number 31. And I told you that I was going to break down the difference between building passive income and building wealth. Well, building passive income really is just a determination on whether or not your money's going to be better off growing a little bit at a time, but consistently, or larger amounts in chunks. So here's the way that I do that, and I've got my calculator up here to show you. I think it just makes it easy. And I'll use some kind of round numbers, all right? Let's say that you can buy and fix a home for $100,000, okay? So there is the buy and fix price. Let's say that you can rent that for $750. Now I'm going to take the $750 rent times 12 because there are 12 months in the year, and then I'm going to take that and multiply it by 0.6 because your rent's going to cost you about 40%. So you're going to net $5,400. Now I know some people say, well, I can rent a property and not pay 40% in my cost. Well, you have property management, you have property taxes and insurance, you have maintenance, and you have additional yada yadas. So just take 40% off. Trust me, you'll always be happy. Now, $5,400 a year is okay, but the question is, how much cash did you put into this deal? Then we determine whether or not you should hold or flip. So let's just figure this out. Let's say you bought it for $30,000. Okay? Let's say that you fixed it for an additional $30,000. So you have a home here worth $100,000 and you paid $60,000. So you're all in at $60,000. What we're going to do is we're going to take $5,400, which was your net rent, and we're going to divide it by your all-in, which was $60,000, and that's going to show you your annual cash-on-cash return, which is 9%. And at 9%, I am not holding this property as a rental. I'm not holding this property as a rental. Here's why. That's 9% on my cash. $60,000 going to make me $5,400 net. 9% on my cash for the year. Why not do this? Why not sell it for $100,000? Flip this house, and if we sell it for $100,000, we have to multiply that by 0.9 because it's going to cost you 10% to sell. And I know some people say, well, it doesn't cost me that much to sell. Yes, it does. You got closing costs, you got your commissions, you got all the yada yadas. It's 10%. Now, then I'm going to take off my purchase and rehab of $60,000, and that leaves me with a profit of $30,000. Divide that by your all-in of $60,000, and you have a rate of return of 50% on your money. How many years would you have to hold that rental at 9% to get to 50%? Well, you'd have to hold it for 6.5, 7 years, okay? Now you've got your money back in the same amount of money that you could have in maybe a 6-month flip. Well, if we have a 6-month flip, then I need to multiply this times 2, and my annual rate of return is 100%. So you can see there are times when we want to hold. Those times when we want to hold is when my cash-on-cash return can be about 16% or higher. I want to flip anytime that I can't get 16% on my money for holding it. But if I can hold it, I'd much rather hang on to the asset long term. There are some creative ways to do that. We'll talk about that more tomorrow.